Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. So the other day I was having lunch with one of my best clients. He's been a client of mine for the last 14 years, more or less. And obviously he's done very well financially. He's got a really good business, and he's got a couple of kids in the business that are going to take the business over. So we've done a lot of planning along those lines. So we've done estate planning. We've also done family protection for him and his wife. And for one of the partners in the business. And then obviously we've done some executive bonus programs for some of the key employees that he has in the business because he wants to make certain that he can maintain those employees close to the house and close to the business from a maximum efficiency and business perspective. But in having lunch with him, one of the questions that he did ask me was, he owns a lot of life insurance, obviously some of it because of his net worth. We have in an irrevocable trust. And then some of the other insurance we're using it for family protection, and executive bonus and supplemental retirement plans. So obviously he owns that himself, and he's got the 3 C's under those contracts. So he's got the care, custody, and control of those contracts, so he can pretty much do whatever he wants. Now, he's a very savvy individual, so he understands money, and he also knows very well how to make money, so that makes him, very, very dangerous from a business perspective. So he wanted me to kind of give him an overview of the importance of insurance in his retirement program and everything that he's done with me regarding estate planning. So obviously it was not something that I was expecting, but because of the fact that I deal in this business every day and have been dealing with it for the last 28 years, so I started to jot down some notes while we were having lunch on a napkin in front of him. So what I'd like to do today is I want to share some of those notes that I did cover with my really good friend and client last week while having lunch. So number one, I'm going to kind of share some ideas as to, the role that life insurance plays from a family protection perspective. Number two, I'm going to share the role of life insurance in asset protection. Number three, I want to kind of walk you through the role that life insurance plays in retirement protection and distribution. And then we'll talk a little bit about the rates of returns and what you hear in the media regarding life insurance and so forth. So I think that will give you a pretty good flavor of the type of conversation I had with my client. Now, from a family protection standpoint, the one major risk that I always try to make certain that I take care on behalf of my clients, whether it is in the creation of a retirement distribution plan or anything else, is family protection and the risk of dying too soon. And the risk of dying too soon has a lot of different impacts that many of our clients or my clients have not really thought through as they were planning for retirement, obviously before they visited with my firm and with me. So the risk of dying too soon has a tremendous impact on retirement accumulation. What would happen if you're 50, 55 years of age and all of a sudden you don't wake up the next day? And it could be because of an illness, could be because of a premature death, a stroke, a heart attack, could be an accident that you had while driving your automobile, could be anything. What most people don't realize is that everyone has an economic value, and we'll talk about that in a minute. But how do you replace that human life? And what is that replacement enough for the family members and the spouses that may remain behind at that point in time. Now remember, when you're 50, 55 years of age, you're more than likely maximizing your income and your income potential. So you're putting money away and you think that you're going to put money away, for the next 10, 15 years so you can reach retirement fairly comfortably, and you're going to be able to maintain a really good retirement lifestyle for yourself and your family. Well, what if that doesn't happen? What if you're not properly insured? Is your family going to be suffering? Are they going to be able to maintain the same standard of living that they have been accustomed to while you were alive? So, as a father and as a husband, I want to make certain that if something were to happen to me tomorrow, that my family would not skip a beat from an economic perspective, and that they can continue to maintain the standard of living along those lines. Now, the other risk in family protection is the risk of, living with a disability and its impact on retirement distribution. So the role of life insurance here plays a major role because you could have disability through a personal disability policy while you're employed, but once you reach retirement, you no longer have access to a disability insurance contract. But if you do become disabled and you have a need for long-term care, which is one of the most critical issues that we're all going to have to deal with in the future, then do you have that income protected, and do you have that disability protected? Have you been able to shift that liability to an insurance company for a premium? Obviously, many of the life insurance policies that are being sold today in the marketplace, and this is why doing an audit to your current insurance program is so critical, but many of the policies that are being sold today also have a long-term care rider, and then have critical illness riders and chronic illness riders along those lines that can help you and your family maintain the efficiency of your standard of living by covering that additional cost that may come upon you and your family when you suffer from a long-term care disability or a debilitating disability like Alzheimer's, Parkinson's, stroke. You may have to go into a home health care facility, assisted living facility, perhaps even nursing home, for a number of years, and there's a tremendous cost assigned to that. Now, in trying to identify, and this is one of the questions that my client asked as well, is how do you determine, how much insurance to have? And there are different ways of doing that. We like to do it at Cambridge from an economic standpoint, because each and every one of us has a human life value from an economic perspective. Now, most everyone out there, whenever we do insurance audit, we realize that, the people that own life insurance, the vast majority of them are underinsured. Because it's like if you own a Mercedes-Benz and is paid in full, but you only want to insure the Mercedes-Benz as if it was worth a Toyota. You don't want to do that, because if you own a Mercedes, you're going to insure that Mercedes for its full replacement value. If you own a $500,000 home and it's paid for, you're not going to insure that home for a small apartment, that is worth $100,000 in case of fire or any other type of liability. You're going to insure that piece of property for its replacement value, which would be $500,000. Well, why should your human life value and why should your life be any different? So you need to make certain that whenever you do the calculations to determine how much insurance you need or assurance does your family need, that you use a human life value calculation. I'll give you a simple example for that. Now, obviously, when we do economic value calculation for clients, we take a lot of issues into consideration, but these are just some of the few that I'll mention. Number one, what if you're 50 years old and you're going to retire in 15 years? Now, you're a productive person. You may be an executive. You could be a business owner. So let's say, for argument's sake, so I'll keep it simple, you're making $100,000 a year. And you're supposed to be producing that $100,000 a year for the next 15 years on behalf of yourself and your family. So right off the bat, if something were to happen to you at age 50, your family would not be receiving that $100,000 a year until your age of 65 would have been, because of the fact that you don't have it properly insured. So you would think that if you're doing $100,000 a year for the next 15 years, that's $1.5 million right off the bat that you're going to need, or that your heirs or your surviving spouse is going to need just to maintain your standard of living. Now, on top of that, you figure that if you're an executive for a company, you're making $100,000 a year when you're 50 years of age, there's a high probability that you will continue to receive raises as you move down the line. So we need to factor an inflation rate based on the type of income that you generate. Now, this is not your simple, 3-4% inflation rate that we see in the marketplace as far as the consumer price index is concerned. This is based on the inflation rate of the type of business that you do and the type of educational background that you have. So if you happen to be an attorney, if you happen to be a CPA, if you happen to be a business owner, what is the growth in revenues that you generate for yourself and your practice every single year? And that's more than likely going to be higher than the traditional 3 to 4%. Now, if you happen to be a regular employee in a company, you might be able to get away with that 3%. But what if you happen to be an executive in that same company? Executives do have a tendency to receive, stock bonus options, stock options, and things like that, and their raises are much, much greater than to traditional rank and file employees. So you need to take all those things into consideration. Obviously, you also need to consider, things that you may want to add some additional buffer in regards to your family. Maintenance. Things have to be repaired. Things have to be replaced. Do you want your family to just receive that $100,000 a year? And then obviously if they have a major emergency that, for instance, they may have to replace a roof in your home where you and your family live, that they can have a buffer to cover those additional expenses? Or do you want your family to use the same $100,000, pay for the repair of that roof? That could be $25,000-$30,000 if you need to replace the entire roof, or even more than that, and then have the rest to maintain the standard of living. So there are a lot of things that go into figuring out what is the human life value calculation from an economic perspective. But those are the things that I discuss with my client, and the more I discussed those issues, the more questions my client asked. So, what was going to be like a 45-minute lunch, it turned out to be 2.5 hours. So I guess in a way, information without education always leads to failure. So I was able to give them a little bit of feedback on that. Now, another issue that you need to be cognizant of is, what are the living benefits of life insurance? And I have covered most of these in other podcasts that I've done, but, some of the living benefits that I did speak to my client about were cash on cash, the accumulation value, the fact that the money grows on a tax-deferred basis. The client has access to all the money in the account without having to pay fees or penalties, whether the client is under the age of 59 and a half or past the age of 70 and a half. The fact that there are no additional IRS penalties that may be assigned to this account. Not only that, tax-free distribution, and the client can take that tax-free distribution at any point in time in the future from a business perspective. So that gives you gives the clients a tremendous amount of leverage from a cash need at a given point in time. Also, because of the riders that I have talked to you about previously, it also covers any potential liabilities for long-term care needs, provides liquidity, which is very, very critical. In the state of Florida and many other states, it also provides credit protection. And most important, if you happen to be a business owner and you're buying equipment or you're doing remodeling and you're going to ask for a loan, most of the banks are going to ask you for a collateral, and you can actually take a life insurance contract and you can collateralize it against an existing loan. Now, you cannot do that with any any type of IRA or qualified plan, 401ks, 403bs, any of those things. So the living benefits of life insurance are just as great as the death benefit of life insurance. Now, from an asset protection perspective, the risk of eroding factors are critical. And life insurance plays a major role in trying to avoid those eroding factors like market and inflation volatility. Let me give you an example. If you have $1 million portfolio and you have that $1 million portfolio invested in the marketplace, we have gone through a number of downturns in the market in which our clients have lost 20, 30, 40, even 50% of their investments. I know in 2008, 2009, 401ks all of a sudden became a 201k because many individuals, many Americans lost 50%. Of their investment in those vehicles. Now, if you're still working, you may choose not to open your statement on a monthly basis because you don't want to see your account heading south every single day. But on the other hand, if you are still working, you're still making contributions to that 401k. If you work for an employer, the employer may be making a match to that 401k as well. And because of the fact that you're still productive and you don't have any need to take any money out of that qualified account, then you do have the luxury to allow that account to recover at some point in time in the future without you missing a beat. On the other hand, once you're in retirement, if you have the same issue where you invested in the stock market and all of a sudden the account drops, and I don't care if you even have money in bonds, because in 2008, the vast majority of bonds in the marketplace also lost in excess of 15 to 20%. So, but now you're in retirement. Now you're not generating any additional income, so you may have no other choice but to start liquidating and taking money out of these qualified plans or these accounts that you have set aside for retirement because of the fact that you need to maintain your standard of living. Now, that creates a couple of problems. Number one, you're not giving the account the opportunity to recover itself when the market starts to head north again. So now you're actually compounding the problem. Not only have you lost 10, 15, 20, or 30% in your account, but you may have also had to take another 5 to 10% out of the account, because when you take, especially in qualified plans, when you take money out of those accounts, you're going to have to pay taxes. So you have to take enough that after paying for taxes, you have a net amount that would be sufficient to maintain the standard of living. Well, life insurance plays a major role. Because if you have a properly set up 7702 plan, in which you have set it up from the very beginning as a supplemental retirement plan, you do have the ability now to start taking on a given year when the market has dropped 10, 15, 20, or 30%, instead of having to dip into those accounts and compound a problem that you already have in your hands, you can now go into your life insurance contract, dig into the cash accumulation, into the cash value, and start taking out an even amount in order to maintain your standard of living. Now, when you do that, a couple of things happen. Number one, these accounts, especially the ones that you would set up with myself and my firm, are guaranteed accounts. So there's no loss, there's no opportunity for you to lose money in those accounts because they're guaranteed. Number two, when you take the money out of these accounts, if you do it properly, you're not going to have to pay federal income taxes. So you can actually take less money because of the fact that you don't have to pay federal income taxes to the government. And by doing so, you're allowing that buffer to continue to grow on your other accounts that you had set up for retirement that are now suffering a loss, and you can wait it out and wait for those accounts to get back to the level where you can start taking distributions from them again. Now, one of the things that I try to do for my clients when we set up these 7702 plans, and the longer we have, the more choices we have, is I want to make certain that we can set up a buffer of anywhere between 3 to 5 years. So if I'm able to set up a buffering program by using 7702 plans that would allow my clients to take as much money out of their insurance contracts in order to meet their standard of living while their accounts are suffering, then that's a win-win for them and for their families as well. Now, the other area that is not related to family protection or asset protection is what we call retirement protection. And because of the fact that I deal with many public employees, primarily law enforcement employees or public safety employees, because of my background in law enforcement for many years, we use a technique called pension maximization. And what we try to do with pension maximization is to enhance the retirement distribution rates for clients at retirement. And let me give you the same example that I gave you previously with $1 million. If you have $1 million in an investment account, whether it is in a non-qualified after-tax account or in a qualified, which would be a pre-tax account like a 401k, a deferred comp, a 403b, IRAs, whatever it may be, you want to make certain that you don't want to run out of money before you run out of life. So when you do that, most financial planning firms are going to tell you, and most publications are going to tell you that you should never take more than 3 to 4% out of your accounts, because if you do so, there could be a probability, and there would be a high probability that you may run out of money before you run out of life. Now, think of it this way. If you have $1 million portfolio, and I'm using $1 million as an example, it could be $500,000, it could be $1.5 million, could be $2 million, could be anything. But if you have $1 million portfolio and you're taking 3% out, to 4%, that means that you're generating anywhere between $30,000 and $40,000 of income annually. Now, you may have to pay taxes on that money, so obviously your net may be a little bit less than that. Well, that's well and good, and because of the fact that if you're married and you're filing jointly and you love your family and you love your spouse, you want to make certain that you don't invade principal. Because if you need more than $30,000 to $40,000 in order to make ends meet, and you start to invade principal, guess what's going to happen to your overall account value? Your overall account value obviously is going to go down. When your overall account value goes down, so does the interest that you're generating out of that account. So you're going to have to compound the problem by taking more and more and more money out of your principal in order to offset the differential in income coming in to maintain your standard of living. If you live long enough and then you die, how much money is there going to be left for your surviving spouse? Is your surviving spouse going to have enough in order to make certain that he or she would continue to maintain their standard of living for as long as they're going to live? Remember, if you're in retirement, you have to be able to plan for at least 3 decades, because there's a high probability most of us are going to live a long life. Now, that creates another problem. If you don't have the ability or the buffer or the straddle to make certain that you can take more than 3 to 4% and not fear running out of money before you run out of life, what else can you do? Now, obviously, if you have a life insurance contract as a 7702 plan, and this would be a 7702 plan that is primarily designed for pension maximization. See, at Cambridge, whenever we do an insurance program using 7702 straddles, we design 7702 straddles depending on the goals and objectives and the needs of our clients. So we have clients where we have designed 3 different 7702s for 3 different issues and concerns altogether, and they work very well incongruently with one another because it makes sense from an economic perspective. So if you do it this way, let's say that now you have $1 million of 7702 plan, and by the same token you have $1 million portfolio, now you have a lot more leverage than you would have had, because otherwise you were going to be exclusively dependent on the interest only, whatever the interest would be. What if a year that $1 million is not producing anything? Well, now you have to dip into principal to offset your standard of living, but you didn't earn any money, so now there's a lot of pressure on that principal that you had set aside for retirement. But if you have $1 million of death benefit, you now have the ability, if you're 65 years of age, you and your spouse, you have the ability to take that $1 million if you wish. You don't have to do it, but you have the ability to walk into an insurance company and say, hey, insurance company, I have fears and I'm very concerned about, outliving my money. So what I like to do is I like to give you the $1 million that I have, and I want you to pay me an annuity for as long as I live. And so it doesn't matter. You could live to the ripe old age of 110 years of age, and the insurance company has an obligation to continue to pay you that income. So in this scenario, when you annuitize that $1 million and you turn it into an insurance company for income, basically what you have done, you have created an additional Social Security benefit. Remember, Social Security benefits for most of us, especially in the age bracket that I work with, they're guaranteed. Nobody knows what's going to happen to the future generations, but at least for us it's guaranteed. Or if you happen to have a pension from an employer, well, those things are guaranteed as well. So now, because of the fact that you annuitized that $1 million contract, now your annuity distribution rate is not going to be 3 to 4%. It could be anywhere from between 7 and 8%, sometimes even higher depending on when you annuitize. So the same $1 million, instead of producing a $30,000 to a $40,000 annual income, that is not guaranteed because it depends on market conditions. Now you can generate the same. Now you can generate 7 to 8% distribution, or $70,000 to $80,000 distribution out of that annuity account on a guaranteed basis for you. So all of a sudden you were able to use that life insurance contract to give you the leverage to be able to annuitize an existing asset and obtain a much higher distribution rate that you would have been able to do otherwise. Remember, the rules of engagement completely change when you retire, because you're going from an accumulation rate to a distribution rate, and in retirement it's all about distribution rates and cash flow. So it's very critical that you do that. So if you have a 7702 plan that is designed for that, then what you have just done, you have multiplied your income coming to you and your family on a guaranteed basis that otherwise you would have never done. And then obviously upon your death, if you took a life income only option and your incomes and the income stops from the annuity payout, then the $1 million of life insurance under the 7702 plan that was designed as a pension maximization plan would now be paid to your surviving spouse, and then he or she can either opt in and do another income or annuity contract, guaranteed annuity payout option, or they can take a portion of that money and just do an option for their monthly expenses, and then use the rest of the money to do other things. So having leverage and having flexibility in retirement is very, very critical for anyone that is truly thinking about having a full and sound retirement life. Last but not least, I just want to share a couple of ideas on rates of returns. People need to understand that when it comes to rates of returns, there are very, very few products, if any, that can actually do, once you understand it correctly, that can compare to the rate of return power of a properly set up 7702 life insurance contract. And the reason for that is the following. There are 3 rates of returns that those of us that truly understand the power of life insurance deal with every single day. Number 1 is the internal rate of return. Number 2 is the external rate of return. And last but not least is the eternal rate of return. Let me explain what I mean by that. The internal rate of return is whatever internal rate of return the product is going to do. Now, whether you have a whole life or you have a universal life or you have a variable universal life or you have an index universal life, every product is different, and their composites and their investments are different, and so forth. And some have guaranteed interest rates, some have non-guaranteed. So the internal rate of return is going to be dependent on the product that we choose. We at Cambridge use all of them because each and every one of them has certain advantages and disadvantages, but when we create straddles, we want to make certain that we can maximize the internal rate of return for our clients as much as we possibly can. The external rate of return is that external rate of return that I just discussed with you with the issue of pension maximization. The external rate of return is that rate of return that the 7702 plan can have because it allows other products in the portfolio that have nothing to do with that 7702 plan to enhance, to be increased, as far as accumulation rate or distribution rate. So that $1 million exercise that I told you just a few minutes ago, in which now the clients could go to an insurance company and obtain an 8% distribution rate as opposed to a 3% distribution rate, they would have never been able to do that unless they had a proper 7702 plan. When done correctly, the 7702 plan external rate of return exceeds somewhere in the area of 16.5%. Tell me on any other product that can do that as well. And then last but not least is the eternal rate of return. Obviously, upon the demise of the insured, then the death benefit proceeds are going to be paid out to the surviving spouse, free from federal income taxes in the United States. Now, because of the fact that most of the clients that we deal with, when we do these 7702 plans, we also include the long-term care riders. If the client had a long-term care need while the client was alive, he or she was able to dip into the death benefit and use a portion of it or all of it, if need be, to maintain their standard of living on a tax-preferred basis and to cover the additional expenses of a long-term care. But if the client was able to die in their sleep, then obviously the beneficiaries would receive the death benefit in full, again, on a tax-preferred basis. So I have never ever met or seen a financial plan or a retirement plan that cannot be enhanced and made a lot better with the advances and the capabilities of creating 7702 and life insurance straddles in order to accomplish that. Now, I do hear from time to time, and I try not to deal with these types of people because obviously it's a conversation I don't care to have with anyone. I hear people tell me all the time, "Well, I don't believe in life insurance." Well, my answer is twofold. Number one, life insurance is not a religion, so you don't have to believe in it. Life insurance is a financial instrument, just like any other instrument that you may have in a portfolio, like real estate or investments or your 401k, mutual funds, stocks, bonds, CDs, whatever that may be. The other thing is when people tell me that they don't believe in life insurance, I always question whether that is true or not, because they probably believe in life insurance. They just don't believe in paying for it. Because if somebody were to say to them, look, there's a 100% probability you're going to die tomorrow, but I'm going to give you the opportunity to buy some life insurance today, how much would you buy? And their answer is going to be, well, how much would you sell me? Because you would want to buy as much as you possibly could. But if you didn't understand the value of the product, then you wouldn't buy it anyway. So, to me, those are just excuses. The one thought that I want to leave you with is that I have been in the financial services industry, and I have been, a tax planner now for almost 28 years. And the one thing that I can share with you is the following. Over the last 28 years, I have delivered multiple death claims of clients of mine that have passed away. Some younger than expected, others older than expected, and then some, somewhere on the averages. And the one thing that I can tell you is I have never, ever ever met a widow that did not believe in the power of life insurance. And that's a fact. Again, I want to thank you all for giving me a few minutes of your time today. And as I always close every single podcast or every single webinar, our job here at Cambridge, my job as a retirement strategist, is to kind of help you change the way that you see things. Because when you do change the way that you see things, the things that you see change. Thank you, and have a great, great day.